Our guest says stock market investors may be too optimistic as cracks begin to show in key areas of the economy. We are joined by Sam Labell, portfolio manager at Veritas Asset Management. Great to see you.
Thanks for having me.
Which economy are you thinking about mostly here?
Well, I mean, we do look south, and the U.S. came out with a raft of economic data today, and a lot of it is just showing that the labor market is softening. And the earnings announcements that we've seen out of a number of big corporations are showing that the mid to lower income consumer in the U.S. is under pressure. There is a benefit that the higher income consumers are actually substituting down. They're starting to stop at the dollar store. But you see companies like McDonald's saying that there's really a two-tier economy. People at the higher income levels are continuing to order in and continue to pay for premium meals, but they're seeing a lot of softness in the lower income and middle income consumers who are just opting not to shop or not to purchase McDonald's meals. And that's carried over to Walmart, which is seeing substitution down. And ultimately, there are some companies that will benefit. If you're in the value segment, you're going to pick up some business. But if you're kind of in the mass market consumer segment, I believe you're going to be a little bit concerned right now on where consumer demand is headed. The job market, I mean, we wish we had this job market for our whole lives, but we're complaining about how the job market is, we're worried about it, and maybe it's slowing, but they have record high employment levels. Unemployment's very low. People are still earning that check every month, and that money is coming into the markets in a large respect. People's savings rate into 401ks is at record levels. So you have the situation where there's a lot of things that are churning on very positive terms, but we have a lot of uncertainty, policy-driven uncertainty. We don't know when or if interest rates will get cut. What are the triggers that would cause this Fed committee to cut interest rates? Slight softness in the job market, is that enough? We're still seeing strong wage gains, for example, in some of these jobs reports. So even though we don't have a lot of new jobs, when people are changing jobs, they're getting decent 5%, 6%, 7% wage increases. And that leads to higher incomes, and that continues to push the economy forward and keeps things stable. Ultimately, we think there will be interest rate cuts because Chairman Powell's term ends in May 2026. So one way or the other, Trump will have his cuts, but whether we're going to get cuts and to what extent before there's a sort of a changeover of the Fed governance, we're still waiting to see. And I think the market's in a holding pattern as well, thinking about, okay, well, AI is its own narrative that can chug forward, but what about the real economy? What about the average company? How are they dealing with tariffs?
Actually, on that, because the U.S. President Donald Trump's tariffs are headed, it seems, to the Supreme Court.
Yes.
Is that noise, or does the market really care about the tariffs, or have they just have investors absorb the fact that there's going to be tariff disruption?
So I think one of the challenges with the tariffs is that we haven't seen the full effects. A lot of companies were able to pre-order the inventory, bring it in. Like if you wanted to get your inventory on the shelves for Black Friday, you had to order it in May, April, May. So a lot of companies got ahead of the game. Right. There's a famous story about Apple airdropping iPhones into the U.S. to avoid tariffs or to avoid the tariff deadline. So a lot of companies were able to stock the shelves in advance. And so now you're seeing that there's actually a decline in reordering, and a lot of the shipping rates are falling because they were able to do that earlier in the year. And because of that, that means that a lot of the inventories that are getting sold out to consumers are at old prices, not including the tariffs. And so we're seeing that prices haven't crept up. Many companies have kept the prices lower than the full impacts that they're seeing on the tariff side to maintain market share. So there's a mix of who's bearing this burden. Some of it's on the consumer, some of it's on the companies, but as that inventory gets replenished at higher rates with tariffs potentially, and we can talk about what might happen with tariffs. Sure. Obviously, the main tariffs that were put out under the IEEPA, which is the emergency act that the president used to get his tariffs through. National security grounds. Those were ruled illegal, essentially, by two trade-specific courts. So these are specialized courts that deal with trade issues. But of course, President Trump wants to take that to the Supreme Court. The Supreme Court has to announce before their next term, or their next session is October 6th. They got to announce before then whether they're going to hear this case. Should they decide not to hear the case, essentially these tariffs are deemed illegal. And then it's a question of the case was brought just on a couple importers and not on a broad swath of the. So there's a question about whether it has to go back to the courts and if they decide not to hear, but I think that's the unlikely case. The Supreme Court would like to hear this case because it's historic. I don't know which way they will go.
Yeah.
But if they uphold this, obviously we're in the status quo and people have already prepared for these tariffs to be real. It's not like the market hasn't seen what could happen. And I think you're heading into a slowdown that's really driven by the consumer. And that would mean that you should be cutting interest rates. Maybe you want to cut a little bit now before it actually hits, before you're forced into a situation where you have to do it.
One stock that's on your radar is Alimentación, ATD.
Yes.
It did report a recovery at last in U.S. non-gas sales yesterday, and that seemed to encourage investors.
Yeah, and we were on, I think, earlier in the year talking about Alimentación Couche-Tard and saying that effectively the valuation had gotten hammered by the 7&I deal. The average institutional investor didn't like the idea that they're getting away from their knitting, which is to do smaller, digestible acquisitions and consolidate the industry and go after this large, seemingly intractable problem of getting Japan to sell something to outside investors. So it was depressed and it was undergoing a lot of weakness in the low-end consumer, negative same-store sales in the U.S., and we had the thesis that they were going to turn around that situation. They're a very well-managed company, and that the valuation was depressed. And that was more or less confirmed by their earnings yesterday, showing a rebound in U.S. same-store sales growth. We still have longer-term concerns about electric vehicle impact. How are they going to weather the fact that effectively driving activity is a bit in decline because of demographics? So you have a number of headwinds, but if they get back to their knitting of doing smart acquisitions, using their balance sheet, I think that would be very well received by the market, and that's what happened yesterday. The stock was up over 6%.
We're tight for time, but would you be a buyer of Alimentación stock right now?
We continue to hold it, and we're reviewing the thesis. We're going to take a look at what we think could happen. Again, this is another company that has some exposure to the average consumer, and that's obviously where I've expressed some concern. But we do think there's value there, and they've kind of gone back to a strategy that we like, which is this acquisition strategy.
Sam, thank you very much. Sam Labell kicking us off there. He's a portfolio manager at Veritas Asset Management.